Welcome back to ETF.com Live, the video edition. My name is Dave Nottig, Managing Director here at ETF.com. Great question in today's live chat about what an ETF can and can't hold. And that's a good question. We've got 2,000, 2,300, 2,400 changes every day, ETFs on the market covering all sorts of things. So what's left? Are there things that ETFs might hold that they don't right now because of some sort of regulatory reason? The short answer is not really. Almost any relatively liquid security in the world can find its way into some sort of exchange-traded package. Now, most ETFs, like say the S&P 500 ETFs we all know, Vanguard's VOO, iShares IVV, State Street's SPY, those are all just really funds under the hood. They own all the individual securities. Really straightforward, very simple. And anything like that, stocks, bonds, that's real easy to do in any ETF structure. When you get a little bit more to the left, you get things like commodities futures. They have to go into a slightly different structure, but they can, and they still do, and we end up with big commodities funds that own nothing but commodities futures. Really, the only restriction is going to be, is it something the SEC is going to let slide through? Most stocks are going to slide through, most bonds are going to slide through. It really takes something unique, like, say, Bitcoin, for the SEC to stand up and take notice and maybe stop a fund from coming to market that might otherwise have slid through. So it comes down much more to, is there an investor protection angle that the regulators are going to look at than anything at the structural level. Even things that may not be directly investable can end up in an exchange-traded package if they go in through something called an exchange-traded note. ETNs are just promises to pay a pattern of returns from a big bank, and theoretically that bank could promise to pay you based on the weather or baseball scores or movie box office grosses. Pretty much anything that you could come up with math for, the bank could offer a note on. And those tend to receive much less scrutiny than actual funds which hold underlying securities because they're just debt. It's really just like buying a bond from any one of those banks as well. So I think the bigger question is, why haven't we seen even crazier ETFs than we might otherwise, even nichier things, stuff like, I don't know, fine art or wine? Well, the answer is, in most cases, those just aren't liquid enough markets to support the daily liquidity that an ETF needs. And second, would investors actually buy them? I think that's the other key thing. Ultimately, what comes out as an ETF needs to be successful in order for it to survive. People need to want to buy it. So I think that ultimately is the end state. Is this something that the market wants? And if it is, I'll bet you it'll end up in an ETF. Thanks for watching. We'll see you next time.